All right, Ned Phelps won a Nobel Prize for his work on the interplay between inflation expectations and unemployment in 2006. So when the Columbia University professor says the new norm for full employment is a jobless rate of about 7%, people listen. Dr. Phelps joins us now from Columbia Business School to discuss the implications of this new norm on monetary policy and inflation. And, Professor, let me ask you, first of all, the non-accelerating inflation rate of unemployment, it's a complex thing for most people to get their head around. Explain to us why so-called full employment involves a level of unemployment.
Well, there's positive unemployment for several reasons. People moving around, companies going broke and other ones being created, you know, all that frictional stuff. And also because companies like to keep their wage rates a little bit higher than necessary to get people in order to give them an incentive to behave well. So labor is to some extent overpriced and in the market and for incentive reasons, and so that's why there's some unemployment. Now, that doesn't mean that it's always a fixed, constant amount. Well,
so we're just looking at a chart of the actual unemployment rate, and it obviously looks like climbing up a cliff here to 9.7%, and a lot expected to be 9.8% on Friday. But the underlying level, the full employment that we're talking about, where the Fed tries to keep employment, I typically think of as 5%. You are saying now that it should be closer to 7%. Why the rise in that?
Well, for me, it's a rise from around 5.5 in the mid-90s to about 7 now. And the reasons for that are much of employment is driven by opportunities to produce capital goods and more generally to engage in investment activity at prices that are very good. So when asset prices are down because the outlook looks poor, because there are no innovations on the horizon and so forth, then investment activity is going to be low, and that's going to transmit itself to reduced employment, thus increased unemployment.
So what are the implications for Ben Bernanke and the Fed here? How does this change the way they set or deal with monetary policy? And does it matter if they agree with you?
I'm not sure that it matters quite yet. I don't think it matters a great deal whether the Fed thinks that there's going to be a landing at 5.5 or whether they think there's going to be a landing at 7. We're so far from either of those numbers right now that I don't see that it's going to affect monetary policy very much. But I think that investors want to know what that medium-term future looks like. Of course, we don't ever really know that, but we can make educated guesses about it. And companies contemplating investment decisions will want to know how large output and employment and incomes are going to be in the medium-term future when they're making their investment decisions.
Oh, let's talk about, I was talking with Tom Keene earlier about the new norm and what kind of innovation needs to happen for us to create jobs to come back down to one of those landing targets from the 9.5%, 10% level that we're looking at. We had the internet, we had inflated asset prices in the housing bubble. What now do we need to create or have created in order to help us solve this problem of high unemployment?
Well, let me clarify. I'm not suggesting we need a new bubble. I do think we need a bubble to go from 5.5 down to 4. And by a miracle, we had the internet boom, which wasn't really a bubble, but we had sky-high asset prices. And then we had the housing boom, which turned out to be a bubble. I'm not saying that we need a bubble. We would need one to get, probably need one to get very, very low. But just to get down to 5.5, we need to have a normal rate of innovation, I think. And right now it seems like The venture capitalists say there are no innovative ideas out there. Potential innovators say there are no venture capitalists out there. So looks like we're cooked.
Does it? I mean, what can we do to fix that? I'm looking at a number of stories here. A lot of people complaining about the weak dollar, but it seems like the U.S. government has a weak dollar policy here. We are giving more money, in a story on Bloomberg today, to states to help fund low-income home purchases, another $15 billion in fresh money to help looks like maybe create the kind of problem that we're trying to solve. And we continue to see, obviously, the easy money, quantitative easing from the Fed. Do these things hurt us, or do they help us to bring back from such an incredible disaster that we faced?
I'm glad you brought up the weak dollar. A lot of economists see only good in the weak dollar. I might be the only economist on the block who sees a weak dollar as a mixed sort of thing. Yes, it makes it more attractive to produce for export, and that's fine. But also, a weak dollar is like a tariff on foreign goods. A weak dollar means it's more expensive for foreigners to supply. It means that the dollar costs of producing for foreigners is greater. So it's like a tariff. Domestic producers are going to want to raise their markups because they don't have to worry so much about inroads by foreign producers who might compete with them. So
it doesn't help our labor markets, is what you're saying.
Yeah, and then the bottom line is then if producers of domestic goods, domestic producers, want to raise their prices relative to wages, and we have a central bank that rightly doesn't want to let them raise, doesn't want to let the price level goes up, then the wage level has to go down. And with the wage level going down, employment will go down too.
All right. Hey, Professor Phelps, thank you for spending some time with us today. Professor Edmund Phelps from Columbia joining us to talk about labor.